Fusion Mobile, quality e-learning experience on the go.
Types of financial institutions and their functions. Financial institution can be referred to all business organizations which hold money for individuals and institutions and may borrow from them in order to give loans or make other investments. Members of these institutions are encouraged to save their money together, which all or part of it may be lent to any member that is in need. In some of these institutions, members collect their total savings weekly or monthly in a rotary form. If part or all of the money collected is given to a member in form of loan, the interest chargeable on the loan is very low. Types of financial institutions. There are two types of financial institutions, which are the banking financial institutions and non-banking financial institutions. Under the banking financial institutions, we have the commercial banks, the central bank, the merchant banks, the development banks, and savings banks. The commercial banks. A commercial bank may be defined as a financial institution which carries out retail banking services set up for keeping and lending money to people owned by individuals, organizations, or governments for the main purpose of making profits. Examples of commercial banks are the Progress Bank, the ACB Bank, the First Bank, the Wema Bank, UBA Bank, the Union Bank, and the National Bank. Central Bank. The central bank may be defined as the only financial institution established and charged with the day-to-day management and control of the nation's monetary affairs, the supervision and coordination of banking and financial activities of the country. Every country has only one central bank whose motive is not to make profits, but to carry out the major financial operations of the central government of the country. The Merchant Bank. A merchant bank may be defined as a financial institution that provides medium and long-term loans, accepts large deposits, bills, and deals in stocks. The existence of merchant banks in West Africa is a recent development. The underdeveloped nature of the banking system, money and capital markets in West Africa brought about the delay in the establishment of merchant banks in these parts of the world. The Development Bank. A development bank may be defined as a financial institution set up purposely to offer long-term loans meant for development projects. Examples of development banks in Nigeria are the Nigerian Industrial Development Bank, the Nigerian Bank for Commerce and Industry. Lastly, the Savings Bank. The Savings Bank can be defined as a financial institution where customers or individuals save and keep their commodities, or a place where commodities like jewelries, wheels, and loans are kept and saved. The non-banking financial institution. The insurance banks. An insurance company or bank may be defined as a financial institution involved in the protection of persons and objects against risks. These companies as financial institutions collect large sums of money called premium from individuals and organizations in order to insure lives and properties. People save money with the insurance companies in form of life assurance, which is paid to them after a period of time if they do not die before then under endowment assurance policy. The hire purchase companies and the building societies. Functions of commercial bank. The commercial bank performs such functions. 1. Acceptance of deposits. They accept deposits from members of the public for safe custody through the three methods: savings, current, and fixed deposit accounts. Lending of money. They lend money to industrialists, businessmen, and other members of the public in form of loans for safekeeping. Agents of payments. They perform these functions to those who deposited money with them by the use of checks to owners of current accounts. Discounting bill of exchange. These banks discount purchase and sell bonds, securities on behalf of their customers. Issuance of bank statements. They assist their customers to settle their indebtedness by issuing bank drafts or by giving them certified checks. Investment and stock exchange transactions. These functions include acting as guarantors to their customers who are buying goods on hire purchase and deferred payments, offering employment opportunities to the citizens of the country where they operate, and involving in agriculture in order to boost food production. They also issue traveler's check. This type of check enables their customers to have money in any country they may go. Foreign exchange transactions. Commercial banks help their customers to get foreign exchange, which enables them to purchase goods and settle their foreign indebtedness. Provision of financial advice. They offer them business advice, which is as important as giving them loans. Types of bank accounts. There are 3 types of bank accounts, which are the current account, the savings account, and the fixed deposit account. The current account. The current account is a type of bank account usually operated by businessmen and organizations, and is required if a customer wishes to make payments through checks. Features of current accounts. In current accounts, money can be withdrawn frequently. 2. Customers are entitled to use checkbooks. Holders of current accounts are not entitled to interest. And also, other people can withdraw money from the account on behalf of the customers. The savings account. The savings account is the most common form of bank accounts. It encourages low-income earners to form the habit of saving. Features of savings accounts. Under savings accounts, money can only be withdrawn occasionally if interest is to be paid. It attracts a favorable rate of interest. Holders are issued with a passbook. Withdrawals cannot be made by another person on behalf of the customer. The fixed deposit account. The fixed deposit account can also be called the time account deposit. This is the type of account that is usually operated by individuals and organizations who have excess liquidity. They put part of the excess in the fixed or time account in order to earn interest. Money deposited in this type of account is always meant for specific purposes for the owners and must last for at least 6 months or more before it can be withdrawn. Problems of commercial banks in Nigeria. The problems of commercial banks in Nigeria are: 1. Urban concentration. Majority of the banks that exist in West Africa operate mainly in the urban areas, thereby denying the rural dwellers access to banks. 2. Low savings. The low level of income makes it difficult for the people to have any leftover that will be banked. Corruption. Fraudulent acts by bank officials and customers is another problem facing commercial banks in West Africa. High level of illiteracy. Majority of the people of West Africa are illiterate and therefore suffer from ignorance about the functions of banks, and that makes them to have no confidence in these banks. Government frequent intervention. Unnecessary government intervention affects the management. The state of the economy of a nation which may be booming or in a state of recession determines the rate at which government will intervene in the affairs of the banks. Low patronage. High interest rates. The people of West Africa have not formed banking habits and therefore rarely patronize these banks. Lack of innovative banking practices, capital shortage, and non-repayment of loans. Checks. The Bill of Exchange Act defines checks as a bill of exchange drawn on a banker payable on demand. Only those who operate current accounts in commercial banks make use of checks. Features of a check. A check performs the following features. It is an order to pay, in the sense that it reduces the burden of counting large sums of money. It is an unconditional order. The amount must be specified. It must be written and not paid. A check account number of the drawer is stated. A check is addressed by one person to another. A stamp duty is paid on a check. Parties to a check. There are three parties to a check, which are the drawer, the drawee, and the payee. The drawer is the person responsible for drawing a check, and he also owns the account, while the drawee is the bank on which the check is drawn. The payee is the person to whom the check is made payable to. Types of check. We have the order check, the bearer check, the open check, and the cross check. The order check. The order check is a check made payable to a person named on it or his own order. What this means is that an order check is only paid to the person whose name appeared on it or another person who will be able to order the bank to pay the money by endorsing the check to be paid to the person. By endorsing an order check, it means that the payee signs at the back of the check and transfers it to another payee. The bearer check. This is a check that is made payable to whoever that presents it, and that is the meaning of the word bearer. It does not mean that no name is written on the check. This means that anybody can present the check in spite of the name written on it, and the bank is obliged to honor it. It therefore means that a bearer check is not safe. The open check. An open check is a check without transverse lines drawn across its face. A check of this nature is cashed at the counter on presentation, or the payee can pay it into his bank account if he has current account. The cross check. It is the opposite of an open check because it has two transverse lines drawn across its face. A cross check is never cashed at the counter. It is paid into the payee's current account. If the payee has no current account, he has to endorse it to another person who has current account. The most important reason for crossing a check is to secure it from falling into fraudulent hands. Forms of crossing a check. There are different forms of crossing a check, which are the general crossing, the special crossing, or the non-negotiable crossing. General crossing. A check is said to be general crossed when two transverse lines are drawn on each face with the words "NECO" or "not negotiable" written or not written in between the two lines. By this type of check, it means that the check can be paid into any bank account. The special crossing check. A check with special crossing has two transverse lines on its face with the name of a particular bank written in between the lines. With this type of crossing, the check is restricted to the bank written on it, which is normally where the payee has a current account. Reasons for crossing a check. The reasons for crossing a check are: 1. It protects the owner against damage by loss or theft. It prevents the check from being paid over the counter. Crossing restricts a check to a particular bank. The holder of a crossed check must pay it to his account. Other forms of check. 1. The stealth check. This is the opposite of a post-dated check, and it has passed or expired dates. That is, it is an expired check. A check lasts for 6 months before it becomes stale. The post-dated check. This is a check with future dates or dated ahead of time, which must not be presented for payment until it reaches the day written on it. Dishonored check. This is a check a bank refuses to pay cash on its presentation. If a check is dishonored by a bank, the bank must give the reason why it was dishonored, and such reason is written on the check. Certified check. A check drawn or ratified by a bank on behalf of a customer is known as certified check. Banks do this in order to restore confidence or genuineness on a check. If a creditor doubts the authenticity of a debtor's check, the creditor may request the debtor to give him a certified check. Reasons for dishonoring a check. There are many reasons for dishonoring a check, which are insufficient funds. When the amount written on a check is more than what the drawer has in his account in the bank. The debt of the drawer. If the bank receives information of the debt of its customers, the bank will not honor any check presented on the account of the debt customer until further notice. Irregular signature. If the signature the drawer signs on the check differs from the specimen's signature in the bank. Difference in figure and weight. If, for instance, the drawer writes 30 naira only in weight and 20 naira in figure. No date. Bankruptcy. Alteration of check. Mutilation of check. The central bank. The central bank is the highest financial institution in a country which carries out the monetary policy of the government. Or it can be defined as the only financial institution established and charged with the day-to-day management and control of the nation's monetary affairs, the supervision and coordination of banking and financial activities of the country. Every country has only one central bank whose motive is not to make profits but to carry out the major financial operations of the central government of the country. Functions of the central bank. The central bank performs the following functions. The central bank is banker to the government in the sense that it is the bank that keeps the nation's money. It issues and controls currency. It is the banker's bank. This means that the commercial banks in the country keep their money with the central bank, and when they run short of money, they go to the central bank for money. It is the lender of last resort. By this function, commercial banks run to it to borrow money whenever they run short of money to settle their customers. Foreign exchange transactions. It manages the national debt. The central bank maintains external reserves. The central bank is also responsible for monetary policy. How central bank controls the commercial banks. There are many ways the central bank can control the commercial banks, and we'll be looking at some of them. 1. The open market operations. This involves the buying and selling of securities from and to commercial banks in order to increase or reduce the volume of money in circulation. If the central bank feels that the money in circulation is too small and wants to increase it, it will buy securities from commercial banks. By buying securities, it will increase the volume of money in the possession of commercial banks and increase their ability to give more loans to members of the public, which will help to add more money in circulation. Liquidity ratio or cash ratio. This is also known as the cash reserve. Commercial banks are required by law to keep certain percentage of their total cash or liquid assets in the form of cash, either in their vaults or with the central bank. The central bank uses this cash ratio which it fixes to increase or decrease the volume of money in circulation in the country. Bank rates. This is also called the discount rate. It is the rate of interest the central bank charges commercial banks and other financial institutions for discounting their bills. If the central bank feels like curtailing the lending powers of commercial banks and other financial institutions, it will raise its discount rates, which will force other rates to rise. Special directives. These are special instructions which the central bank gives to commercial banks and other financial institutions as to which directions their lending policies should follow. The central bank will tell them the sector of the economy they should direct their lending policies. In this case, if for instance the nation is pursuing agricultural and industrialization policies, the central bank will direct them to give more loans to farmers and industrialists. Moral suasion. This is persuasion based on moral grounds, not with the use of force of law by the central bank. It takes the form of gentle appeal by the central bank to commercial banks as to the kind of lending policy they should adopt regarding the expansion or contraction of money supply. Non-adherence to this appeal by commercial banks can then force the central bank to apply the force of law. Bank clearinghouse. A bank clearinghouse can be defined as an institution established by member banks to simplify exchanging and obtaining of payments for the checks that are paid into bank branches throughout the country. Types of bank clearinghouse. We have the local clearinghouse, the head office clearinghouse, and bankers clearinghouse. Development bank. The development banks are specialized financial institutions which provide long-term credit or loan to other enterprises for capital projects. Examples of development bank are the Nigerian Industrial Development Bank, the Nigerian Bank for Commerce and Industry, and the Nigeria Agricultural and Cooperative Bank. Functions of development bank. The development banks perform the following functions. 1. They provide funds for capital projects. They help to implement government financial policies, especially those policies that affect industrial development of the country. They also increase the manpower development. They implement government policies. They render special advice, supervision of development projects. They give loans for their establishment in order to make sure that the money is not diverted to other non-development purposes. Merchant banks. The merchant banks are financial institutions which perform specialized functions such as accepting bills of exchange, issuance of loans for foreign trade transactions, issuance of new shares, and provision of medium and long-term loans. The existence of merchant bank in West Africa is a recent development. Functions of merchant bank. They perform the following functions: discounting of bill exchange. They also give loan to foreign traders. They advise the companies, that is, they act as advisors to other companies. Underwriting of shares. They provide long-term loans. They also perform other banking functions like foreign transactions involving letters of credit to meet the needs of commerce and industry, bank guarantees and endorsements, commercial paper, export promotion, pension and fund management. Mortgage bank. The mortgage banks are financial institutions that specialize in granting loans to individuals and corporate bodies for building purposes. The mortgage banks are not many in West Africa like other banks because of the restricted functions they perform. The mortgage banks are also known as the building societies. Functions of mortgage banks. The mortgage banks perform the following functions. Acceptance of deposits. They accept deposits from members of the public for safekeeping, thereby encouraging them to save for the future. 2. Provision of long-term loans. 3. Development of mortgage institutions. 4. Give advice on housing matters. They advise and assist the government on housing matters. Provision of houses, in the sense that they construct and provide houses and social amenities to especially low-income group. Insurance companies. The insurance companies are financial institutions that are concerned with insurance. Functions of the insurance companies. The insurance companies perform the following functions. It facilitates international trade. The insurance companies offers investment opportunities. It leads to risk reduction. They also provide security. They provide a means of savings or livelihood. They serve as collateral security to other banks. The insurance companies also motivate workers